Are robo-advisors such as Betterment and Wealthfront worth the cost? How much does a 25 basis point fee really affect your returns? And can tax loss harvesting and rebalancing increase your wealth? We'll answer these questions and more on the 136th episode of the DoughRoller podcast.
Welcome to the DoughRoller podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey, everybody. Hope you're having a great day. It's a early Tuesday morning for me. I've got a cup of coffee in front of me. I've already checked the news, pulled the Wall Street Journal out of the driveway in the pouring rain. Fortunately, they double bagged it. Thank you, Mr. Wall Street Journal. And I'm ready to get the day started. Today, we're going to talk about robo-advisors, specifically going to kind of focus on Betterment and Wealthfront. But the question is, a question I've been asking myself for our own investments, are they worth the cost? You know, there's an added fee when you use a robo-advisor. It varies from one to the next, but there is an added fee. And the question is it worth it? And, we'll walk through that today. And it's something that I've been thinking about very seriously as I decide, do I keep my investments sort of in a traditional account like at Vanguard, which is where most of our assets are held, or do I, make the leap and move a fair amount of investments to the folks at Betterment or Wealthfront or perhaps Future Advisor or one of the other many robo-advisors. So that's the topic of today. Before we get that, couple of things to cover. First, if you haven't already, I'd be grateful if you would go to iTunes and leave a review of the show. I don't check the reviews, too frequently, probably maybe once a month, just to see what folks are saying so that I can know what I'm doing right, know what I need to improve on. So if you haven't left a review, I would greatly appreciate it. And also wanted to share with you a tip of the day. And here it is. Track your progress. Whatever goals you have, they could be financial, they could be, health, exercise, whatever. Track your progress. And this tip came from a reader. I get a ton of email. I love to hear from you. And I got an email. Normally, I mention the person's first name. I can't actually do that on this one because they didn't leave their name at the end of the email, and I can't get it from their email address. Normally, if it's whatever Frank@gmail, then I know it's Frank or something. But here, if I were going to use the information before the @ symbol in their email address, then I can tell you this tip comes from a listener named 9957576. There you go. So I appreciate this tip, and what this person sent me was a link, and it was a link to an article on the Personal Capital blog, and it was discussing a study that was done, and the study came out of UCLA, and it concluded that it linked the use of personal capital to a 15% increase in savings. And the simple reason behind it was that folks that use personal capital could, with a smartphone, a tablet, of course, their computer, very easily see how much they're spending. Because I talk about personal capital as a way to monitor your investments, which is what I use it for. But I also link my checking account, my credit cards to it, so I get to see all of my spending. I really get to see a snapshot of my entire finances in one place. And so, you can't, as long as you're looking at it maybe once a day or every other day, you really can't hide from your progress. And it allows you to make mid-course adjustments throughout the week, throughout the month, both on how you're spending money, but also how you're saving money. And so I thought this study was interesting, and I will send this page out on my Facebook page and the Twitter account. Those are both, they're at DoughRoller or facebook.com/DoughRoller. So you can check it out. But I thought that was a very interesting study, and it sort of dovetailed with something else that another app that I'm using, and it's called MyFitnessPal. It's a free app that basically allows you to track everything you eat and all of your exercise. On the eating front, it allows you to very easily add food because they've got a big database of basically every food and restaurant you can imagine, and it will easily track your calories. I'm not a big calorie counter, but I think keeping a food diary for a time is probably a good thing for me, and very easy to use. But the thing I've noticed as I use this, and I've only used it for about a week, is that it really does affect my choices, because I can see, I can see very easily what I've eaten that day, how many calories I have left, even though, again, I'm not a big calorie counter, but you can set up a plan. It shows you how many calories you have left. It shows you how many calories you've burned if you've exercised that day. And it kind of, when you go for that bowl of ice cream at 9 o'clock at night, you think, oh my goodness, this is going to send me well over my calorie count. It does change behavior. At least it does for me. I think it might for you. So the tip of the day is track your progress. In terms of these tools, if you just search for MyFitnessPal, you'll find it. It's a free app. In terms of personal capital, you can check them out at DoughRoller.net/PC. That is an affiliate link. But Personal Capital, their financial dashboard is free to use, and tracking your progress just may make you a bit wealthier. So I appreciate the tip and the link. Like I said, I love hearing about new research, new studies, new tools. If you have any in mind, would love to hear from you. Just shoot me an email, dr@DoughRoller.net. Okay, on to the main topic of today, and it has to do with robo-advisors, and are they worth the cost? Let me read you an email I got from a listener named Steve, who's emailed me from time to time. He's kind of wrestling with this same question. He writes in, he says, the other timely podcast was the robo-advisor one. I'm in the process of helping my mom move her accounts from Morgan Stanley over to Vanguard, where I'll be managing them for her. Meanwhile, my IRA and taxable accounts are all at Betterment. It's always in the back of my mind whether I should be paying the 15 basis points or moving my money to Vanguard. The end of your podcast reassured me a little. I'll be really interested to hear your follow-up podcast. Betterment just makes it so dang easy to automate my deposits into my taxable accounts. I feel like I'm getting more value for the taxable accounts and less for my IRA accounts. The reason being that my IRA is static. I'm not adding to it. It seems like it would be simple enough for me to rebalance it myself once or twice a year. On the other hand, my taxable investments I automatically invest into every time I get paid. Betterment is able to balance them easily with the new money. Well, Steve, it's a great email. I appreciate you sending it in. And it's some of the questions that I've been asking myself about our own investments. Do I, the convenience factor, the cost factor, is it worth the cost? One of the things I want to do today is break this down. I've got sort of 5 things I want to cover. What we're going to do is look at what the cost is, what the impact of that cost is, and are there things that these robo-advisors can do for us that might make up for some of that cost? Now, in Steve's email, he mentioned a podcast that I'd already recorded on robo-advisors. If you haven't listened to that, it's podcast 132. So it's DoughRoller.net/podcast 132. And there I was trying to put robo-advisors sort of into perspective and, just at a high level, talk about them and what they can do for us. Today, we're going to get down into a little more of the details. And, this sort of a bit of a summary from podcast 132, but robo-advisors, I think, can be great for new investors who may be uncomfortable going it alone. They're just getting started. They're a little uncertain about asset allocation and the mechanics of buying funds and rebalancing. Robo-advisors do that, of course, for you. So it can be great for those folks. It can be great for those that want some help but don't want to pay 1% or even more to an advisor. They want to pay something a lot less, and maybe they don't need the hand-holding that a human advisor might provide. And even those that have invested for a while but just still feel like they need some help with the asset allocation, which can always be, I think, for some it seems so easy. For others it's a challenge, and I get that. And the rebalancing side of things, they just want that extra help. So I think robo-advisors can serve a very important function for folks. Now, that being said, I've been hesitant to move much money into accounts with the folks like Betterment or Wealthfront. And I think there are a couple of reasons for that. One is, I guess I'm old school. I've been doing this for, nearly 25 years. I've been investing on my own, dealing with asset allocation on my own, dealing with rebalancing on my own. It's kind of just what I've done. And so, it kind of takes some time to think whether you should change what you've been doing for more than 2 decades. That's probably a big part of it for me. There was also the tax consequences of moving my taxable accounts. Now, that's still an issue and something that I need to work through. It's something that I talked to the folks at Wealthfront about. And in fact, we'll have an interview with the folks at Wealthfront, not in the next podcast, but the podcast after that. We talk about that. That's certainly an issue for me. If you have taxable accounts with significant gains, unrealized gains, it's going to be an issue for you too. All of that said, though, my biggest hurdle was the cost. And, it may not seem like much. We're going to talk about that. Betterment is 15 to 35 basis points, depending on how much you have invested. Wealthfront's 25 basis points. Future Advisor is 50 basis points. I would say, by and large, all of the robo-advisors fit within that range of costs. And my thought was, why add that extra level of cost? I've been doing this for so long. Just keep doing what I'm doing. Why pay the extra cost? Well, that's really what I want to tackle today. Is the cost worth it? And I've started to change my view on that and come around to think, yeah, the cost may be worth it. And that's what we're gonna focus on today. And let's first start. I want to kind of cover 5 things. Number 1, the cost is reasonable, right? I mean, they're not charging you 2% or 1%. As I mentioned, I would say the average comes in around 25 basis points. If you have $100,000 or more at Betterment, it's 15 basis points. Now, I say the cost is reasonable, but one of the things I'll hear folks say is something like this. They'll say, well, yeah, it's only 25 basis points. Take the word only right out of that sentence. We should view 25 basis points as a big deal. At a minimum, we shouldn't dismiss it as something insignificant. The fact is, 25 basis points multiplied over a lifetime of investing is worth the value of a home. 25 basis points matters. Now, I love the math. Let's go to the math. So I've pulled up a spreadsheet. I did a little number crunching before I hit the record button on this podcast, and kind of want to walk through some of the numbers I came up with. So here's what I did. I assumed that excluding the cost of the robo-advisor, we'll earn 8% on our investments. Again, that's just an assumption. You can use a different number. So that's after the fees that the ETFs or mutual funds will charge us. But it's before the robo-advisor fee. So I just assumed 8%, and I assumed that we would invest $1,500 a month, which is $18,000 a year, which will be the 401k limit in 2015. Again, pick different numbers if that works for you, but I think this will show us just how much 25 basis points matters. Now, over the course of 10 years, investing $1,500 a month and earning 8%, before taxes, what's your account balance? Any guess? Well, I answer it for you. It's $275,000. $274,419.05 if you're keeping score at home. Now, what happens if we take the 25, I'm going to use 25 basis points as an assumption here for robo-advisors. What will that do to our returns over the course of 10 years? Well, it's not a huge difference. You end up with a little over $270,000. The difference is only $3,794.28 over 10 years. It's over a decade. Not a huge difference. But that's 10 years. What happens if we move that up to 20 years? Well, the numbers, as you might imagine, because of compounding, they get bigger. And I'm changing the formula here in my Excel spreadsheet. Now, over 20 years, the difference is almost $27,000. You have $883,000 at 8%, but with that 25 basis points fee taken out, it drops to $856,000. All right, well, let's keep moving. 30 years. And by the way, these numbers get really, really big, even maxing out a 401k. Of course, 30 years is a long time to invest. Now the difference, $110,000, $2.235 million versus $2.125 million. Now, let's get to 40 years. This is someone who invests, let's say, from 25 to 65, right? And so we're dealing with 40 years. The numbers get really big. The difference now, you're talking between 5.2 and 4.8 million. The difference is $364,000. That's a big difference. Now, if we wanted to really think about this number, you might be saying, you might be saying, well, wait a minute, Rob, that's over 40 years. That's fine. But $364,000 40 years from now isn't going to be worth, $364,000 in today's dollars. Well, you're right. And I did a quick sort of present value calculation, assuming a discount rate of 5%. And this is probably more math than most of you ever want to hear, and I get that. Present value, let's tag it at 50 grand. Still, 50 grand is a lot of money. And so the question is, do we want to spend that? Now, again, that's over 40 years of time, which is why I say I think the costs of these, I call them robo-advisors, maybe automated investment services is another term I've heard. It's reasonable. It's not something that we should simply dismiss out of hand. We shouldn't say it's only 25 basis points, but it's reasonable. I like to do the math to see, to translate 25 basis points into real numbers, something we can really understand, something that, really hits home for us, that helps us feel the impact of it. But I still think it's reasonable. The question I had was, all right, do these automated investment services offer things that might make up some of that cost? Am I really paying 25 basis points? Or do they add some features that might actually result in my making a little more money in my accounts so that 25 basis points gets reduced? Maybe I don't recoup all of it, but maybe I can recoup 10 basis points, 15, 20. Maybe I can recoup all of it. That was my question as I started looking through this. And then, of course, there's other factors as well. So let's walk through them. So again, point one is the cost is reasonable. It's not irrelevant. It really matters, but it's reasonable. All right. Point number two gets to rebalancing. And one of the questions I ask myself is, does rebalancing actually increase your returns? Well, if you do research on this, Google, does rebalancing increase your returns? You're going to get all kinds of really good studies and research from some really smart people and organizations. And you're going to find kind of a couple of different answers to what seems like it should be a simple question. And it's not. Some folks will say, well, rebalancing really doesn't increase your returns. It really reduces your risk. And here's the theory. Let's assume you've decided on a 70-30 allocation, 70% stocks and 30% bonds. If stocks in the long term outperform bonds, which we expect that they will, then over time, that portfolio is going to get out of balance. The 70% in stocks is going to go to 71%, 72, 75, maybe over enough time, 80%. And of course, as your stock portion goes up, what happens to your bond? Well, it's got to go down. So if your stocks get up to 80%, then your bonds are down to 20, right? That's just simple math. And you now have a riskier portfolio, meaning you have a portfolio that will have bigger swings, more volatility than your 70-30 portfolio. Now, if stocks continue to outperform bonds over the long term, that 80-20 portfolio will actually have higher returns, but it'll have higher risk. So some see rebalancing as a way to keep your portfolio in line with your plan. Your plan is based in part on the risks you're willing to accept. And so it's really a risk-reducing strategy. And I think there's a lot of truth to that, particularly when you and I are doing the rebalancing. We're not computers, right? So we can't rebalance like the computers do at Betterment and Wealthfront. And I'll talk about that in just a second. So how do we rebalance? Well, I've talked about rebalancing in the past, podcasts 50 and 51, so you can check those out. But we tend to rebalance either on a calendar basis, maybe once a year, which I think for the vast majority of people and markets is perfectly fine. Some of us try to get a little more sophisticated and rebalance when our portfolio gets out of whack by a certain percentage. That's fine too. It takes a little more work, maybe even a lot more work. But even then, we tend to rebalance maybe once or twice a year. It gets complicated too, because you may have something that needs rebalanced in, let's say, a 401k, but for whatever reason you can't rebalance it within your 401k. Maybe you don't have any more money within your 401k to actually do the rebalancing. So then you're thinking, well, I guess I've got to go buy that fund in an IRA that I have, if I have one, or maybe I've got to rebalance that by buying it in a taxable account. It gets complicated and messy. And that definitely affects how and when we rebalance. In contrast, the folks at like Betterment or Wealthfront, they use computers to do all this, right? There aren't folks sitting at a computer screen looking at your account with a spreadsheet thinking, gee, should I rebalance Rob's portfolio today or not? Let me do the math, right? They have computers that do this. And so I think the rebalancing is all trigger based on how much each asset class drifts from the plan. And so if there is a big market swing, which happened earlier this year, that throws your assets classes off by a certain percentage, it fires rebalancing. It happens, instantly, and it happens before you even know it happens. And so they're able to take advantage of market swings and to rebalance in a way that I just don't think most of us can do. I certainly know I can't do it, and I know I spend more time looking at my investments, I'm sure, than the average person. Maybe not as much as some of you. I look at it at least once a month, and there's just no way I can keep up with the computers at Betterment and Wealthfront. So my going-in assumption is that there will be some increase in my returns given the risks that I'm willing to take by using a robo-advisor. Now, it gets a little tricky. There's really no way to quantify that. There is an interesting article on Wealthfront. I will leave it in the show notes, the link to it in the rebalancing section. And it talks about this issue and concludes from it cites Swenson, who's the guy behind the Yale endowment. He manages all of Yale's endowment funds, and has written a great book called Unconventional Success. He puts it at 40 basis points. I'm just not sure. I don't rely on that. I mean, he's an awfully smart guy. It's hard for me to believe. Maybe in his world with what he does, maybe it does generate 40 basis points in additional return. I find that hard to believe, but I do. At least in the case of our kind of investing. But I do believe that rebalancing that folks like Betterment and Wealthfront can offer will add some level of value and take away and help us with that 25 basis point cost. Again, very difficult to quantify. He put it at 40%. Again, I have a hard time believing that. Obviously, if it were 40 basis points, it would not only take care of the 25 basis points in fees, but it would add another 15 basis points in returns on top of that. So that's rebalancing. Now, the third thing, so we've talked about the cost is reasonable. Rebalancing, I think it adds some level of return, hard to quantify. The third one is tax loss harvesting. This absolutely adds returns to our investments. There's no question about it. So let's talk about what it is briefly. First of all, it only applies to taxable accounts. So if you have only retirement accounts at a robo-advisor, you will get no benefit from tax loss harvesting. It only applies to taxable accounts. And the idea behind it is pretty simple. If you have investments that are at a loss, you sell them, you realize that loss, you can then use it to offset any realized gains you had in the year. Plus, you can use up to $3,000 of your losses to offset other income. And then if you have additional losses beyond that $3,000, they can carry over to future years. Now, there are a lot of papers, white papers, on exactly the benefit of tax loss harvesting. I'm going to leave links to 3 of them in the show notes in the tax loss harvesting section. Let me briefly talk about each of them. The first is from Wealthfront. Obviously, they have some very sophisticated tax loss harvesting technology built into their services. They peg the benefit with a whole host of assumptions at 28 basis points. So right there on tax loss harvesting alone, assuming, again, you have taxable accounts with Wealthfront, you would make up not the cost of their services plus an additional 3 basis points. Now, again, there's a lot of assumptions baked into that. We're going to talk about those in just a minute, but that's their white paper. Betterment actually puts it at 77 basis points. I find that one hard to believe. At least I can't imagine that in my case I would get 77 basis points of what they sometimes refer to as tax alpha. That is, that increase in returns because of tax loss harvesting. The third one I'll mention, again, these are all linked to in the show notes, is Michael Kitz's, who I've mentioned in the past. He has a great blog, and I've emailed him in the past, and I think he's going to be on the show actually in the future. We just got to get our schedules worked out. He has a very thorough analysis of tax loss harvesting. And he pegs it, again, based on the assumptions in his article, at 44 basis points. But it's clear, no matter what assumptions you make, that there's going to be some benefit from tax loss harvesting. Here are a couple of things just to think about with tax loss harvesting. First of all, it's a tax deferral strategy. It's not a tax avoidance strategy. When you sell something at a loss and then buy something else in its place, you're effectively deferring the taxes because it's going to have the result of lowering the tax basis of that new investment. Let me give you an example. Let's say you put $100,000 in an S&P 500 index fund, and in the first year, it loses 10%. So you're down to $90,000. So you sell it. You get the benefit of a $10,000 loss that you can use to offset other gains and up to $3,000 of other income. That's great. And you buy a new investment. Now, you don't buy the same fund right away because of the 30-day wash sale rule, which would basically wipe out your tax loss. So let's say you buy a different fund. Maybe you buy a total market index fund. And you invest it right away, and you're investing $90,000, right? Because that's what you have. And let's say it goes back up in a year or two to $100,000. You have the same $100,000 you started with. However, you have $10,000 of gain built into that, right? Because you bought it at $90,000. So that's what I mean by it's a tax deferral strategy, not a tax avoidance strategy, assuming you're a long-term investor, as I assume most of you are. That being said, it still has a great benefit. I mean, you think about a 401k. What's that? It's a tax deferral strategy, right? It's not a tax avoidance strategy. It's a tax deferral strategy, but it has great value because until you sell that investment and realize that extra gain, you get that money that you benefited from the tax deferral, and you can invest it. And so it's very valuable. But if you think about its benefits, you can almost liken it to a traditional retirement account versus a Roth, and you're thinking, well, which one should I invest in? And it's oftentimes a question of, well, what's your tax rate now when you're making the investment versus what it'll be when you take the money out 10, 20, 30, 40 years from now? Well, with tax loss harvesting, it asks very much the same question. What's the tax benefit you're going to get now, which depends on your tax rate, right, and your state income tax rate, versus what you'll pay down the road when you eventually sell the investment, your new investment that you've bought into, and what will your taxes be on that? So a lot of it goes into what your taxes are now versus what they will be down the road. And just like the question of a traditional retirement account versus a Roth retirement account, it's very difficult to know. If we assume that your taxes are going to stay roughly the same, your tax rates are going to stay roughly the same, there's no question that there is a benefit. And in my opinion, the benefit is good enough to recoup the full 25 basis points. Again, that's only in your taxable account. So that's the third thing. I mentioned rebalancing. I mentioned tax loss harvesting. When you combine those, particularly obviously you have a taxable account, when you combine those, I've come to believe that you can make up most, if not all, of the cost of a robo-advisor. That's kind of where I've come down to. I should say this, I mentioned too that with rebalancing, these services can rebalance in a way that you and I just can't. The same is true with tax loss harvesting. In fact, it's even more so with tax loss harvesting. They have both Betterment and Wealthfront have systems in place. They have, when they sell one ETF, to avoid the wash sale rule, they already have a second ETF that will invest in roughly the same asset class so that you don't have what's called tracking error. You don't want to sell an S&P 500 fund and then use the money to go buy an emerging markets fund. That's a totally different kind of investment. But maybe you can take the S&P 500 money that you've sold and invest in a total market ETF, which is a little different, but not significantly different. It keeps the tracking error down. They can do tax loss harvesting at a level that you and I can't even dream of doing manually. Just not possible. And in fact, there was a lot of tax loss harvesting going on this year when the market dipped. That for most of us wouldn't have even been possible. So I think between rebalancing and tax loss harvesting, you can make up the cost of these robo-advisors, certainly significantly reduce that 25 basis points. So that's 1, 2, and 3. Costs are reasonable. Rebalancing adds, I think, some level of additional return. Tax loss harvesting and taxable accounts definitely offers some additional return. Point number 4 is this. With these investment services, you can do what I call account level asset allocation. And to me, this is just a huge benefit. It may not add returns necessarily, but it's a huge, it makes asset allocation across multiple accounts and rebalancing across multiple accounts extremely easy. Let me explain what I mean. Doing it manually, like many of you, I have a 401k, I have multiple IRA, I have a regular IRA, I have a inherited IRA, I have a SEP IRA, my wife has an IRA, I have taxable accounts, and I'm required to create an asset allocation plan across all of those accounts. Now I have a couple of options here. I could figure out my asset allocation plan. I could then figure out what investments I want to execute on that plan. And then I could do that individually for each and every account that I own. I could treat each of them separately. And so for each account, if I had, let's say, 7 different funds that I was going to use in my asset allocation strategy, I would own each of those 7 funds in each of my accounts, and I would rebalance each account separately. Well, as you might imagine, that would be a very difficult, not to mention the fact that I'd have to have completely different investments in my 401k at Fidelity than I could have at my IRAs at Vanguard. That would be extremely difficult. However, at an automated investment service, that's exactly what you can do, right? Because it's easy. It's just a click of a mouse and it's done for you. You don't have to worry about whether the account, the investment options will be available in this account versus that account, if they're all at Betterment or they're all at Wealthfront or wherever, whatever automated investment service you choose. They obviously have those investments, and you can just, with the click of a button, have that allocation strategy set up for each and every account that you have. In my case, I do an asset allocation across all of my accounts, right? I can't really do, as a practical matter, account level asset allocation. So I have to do it across all of my accounts. And this gets me to the 5th and final point, and that is convenience. I think that has some value. In the case of asset allocation across multiple accounts, it can be a royal pain, and rebalancing can be extremely difficult. And I'll give you just one example. I own a commodities ETF in my SEP IRA. Not a smart move, by the way. I should have it in a taxable account because it doesn't generate interest in dividends and capital gains until I sell. So I should have that in a taxable account, but that's a story for a different podcast. But I have it in my SEP IRA, and it's gone down in value. And so I should be rebalancing into that fund. Well, there's a problem. I don't have the assets available in my SEP IRA to do that. So now what that means is I've got to go buy that fund in another account. Well, I can't get that fund through my 401k, so that's out. I probably need to have it in my taxable account anyway, as I mentioned. So now I should buy more of that fund in my taxable account. But what if I don't have assets to do that? Well, I can't rebalance now. So it's a real problem. Or I can rebalance. Maybe I do find the assets, but I've got to take it out of a bond fund that I really didn't want to take money out of. I wanted that bond fund in my taxable account, in my case, a muni fund, because I wanted assets in somewhat less risky funds in my taxable account so that I can maybe tap those if I needed to in an emergency. But now to rebalance, I've got to take some of that out of that safer bond fund, put them into a commodities fund, which can be highly volatile, and it's just not what I wanted to do. You can see the problem. Robo-advisors just add a huge level of convenience. You set your asset allocation plan based on the risk you're willing to take. It's very easy to do with Betterment and Wealthfront. And then they do the rest. And you can have as many different accounts as you want. Doesn't matter. You can set the asset allocation for the same for each of those, and they will divide each account up at an account level, as I mentioned, and rebalance. And it's just the convenience level is huge. And here's the issue. Because doing this on your own can be inconvenient, what happens? We don't do it, right? We don't rebalance like we should. We don't maybe set the asset allocation plan like we should and execute it because, like I've mentioned, you run into roadblocks. I don't have that fund in my 401k, or I don't have enough money in my IRA to do the rebalance that I need. So convenience is a big deal. And it's kind of, even though I've done this now for more than 2 decades, it's gotten me to the point where I am taking a very serious look at both Betterment and Wealthfront. I've opened up accounts now at both. And I did that in part because I really want to understand how each of them work. I've had my Betterment account actually for a number of years. I just opened up a Wealthfront account, and I'm looking to see how Wealthfront works. They are, as you might imagine, similar, but there are some significant differences. And I'm actually going to put together a podcast on that, Betterment versus Wealthfront, so that you can understand the differences. I think they're both very good options, but there are some significant differences. I will talk about that in a future podcast. If you want to check either one of them out, you can. DoughRoller.net/Betterment or DoughRoller.net/Wealthfront. Those are both affiliate links, and you can check those out if you'd like to. As I said, I'm using both of them at the moment, and we'll put together a podcast on comparing them in the future. And I'm going to make a decision on what I want to do with my assets. Now, what are my next steps? Well, for me, the first thing I'm going to do is talk to Vanguard about its advisor services. It has launched a relatively new advisor service where you can work with an advisor. The cost is 30 basis points. I want to understand how that works. I'll be honest, I'm somewhat concerned about how they do rebalancing and tax loss harvesting. I don't know if there is a computer behind the scenes doing this work on an automated basis like the folks at Wealthfront and Betterment have, or if it's an actual human being. And that makes a difference, because the day is coming when computers, really it's here now, computers should be doing this. A human being should not be rebalancing or dealing with tax loss harvesting. Computers are just better at it. That's my big question for Vanguard, how they do that. And then the other question will be, what are my options in terms of my asset allocation plan? With Wealthfront and Betterment, you pick the difference between stocks and bonds, but after that, they pick the asset allocation and the funds and the percentages. You don't have much choice. I think their asset allocation plans are both really good, so that doesn't concern me. But I would like to know how Vanguard works it in their advisor services. Is there more flexibility? Second step then will be, depending on what I decide with Vanguard, is to decide between Betterment or Wealthfront, or possibly both. I could see using Wealthfront for my taxable accounts because there's somewhat more robust tax loss harvesting tools, and I'll talk about that in the upcoming podcast, and using Betterment for my retirement accounts because for accounts over $100,000, they're only 15 basis points, 10 basis points cheaper than Wealthfront. And of course, with retirement accounts, I'm not concerned with tax loss harvesting. So I could see using both. The other thing about that I'll say is I kind of like not having all of my money in one place. And so there's another advantage to using both as well. The third thing I want to look at, particularly if I do go with the Betterment/Wealthfront approach, is this. In my 401k, where I can't shift that over to Betterment or Wealthfront, going to a target date retirement fund, something that I've never done in the past. Again, part of that, I think, old school mentality. And, there's a lot of sort of pros and cons to target date retirement funds. That could be a whole nother podcast, and maybe I'll put that together. But Fidelity offers them. I much prefer Vanguard's because they're cheaper. So that's one of my concerns with the target date retirement funds at Fidelity. But again, you get the huge convenience factor. So that's something I'm going to look at. By the way, through Fidelity, I can use their brokerage link and invest in just about anything that I want to. So one option there would be to use the brokerage link and then sneak over to Vanguard and use their funds. By the way, Fidelity, I love you. You've got some great funds, and your S&P 500 fund that I have at my 401k is fantastic. I do wish the target date retirement funds were a little less expensive. Well, there you go. That's my take on robo-advisors and whether the cost is worth it. I'm coming to the conclusion that it really is, that you will recoup some of the costs through rebalancing, and if you have taxable accounts, through tax loss harvesting, and that the convenience factor is worth a certain amount of the cost. And at the end of the day, it really is worth the cost. So I'm taking a serious hard look at moving a significant portion of our investments to Betterment or Wealthfront, or more likely both. And I'll let you know about that in upcoming podcasts. Would love to hear from you on this topic or any topic. If you have questions, love to hear from you. Shoot me an email, dr@doughroller.net. I read every email and I respond to every email. And if you haven't yet, please go out to iTunes and leave a review for this podcast. I'd really appreciate it. Hey, until next time, remember, the best thing money can buy is financial freedom.